What's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast, and welcome to another Whiteboard Fireside Chat. And today we're going to be talking about capital gain distributions, all right? Because it is December and 'tis the season. This is the month where most fund families, if they are going to pay a capital gain distribution, it is going to be now. So check your statements, see if you've received any capital gain distributions, okay? And particularly if those distributions were made inside of a taxable brokerage account. All right. And in a small amount, that's not going to be too painful. But, I had this client I was thinking about recently where we brought him on at the beginning of 2023. And, high income earner, physician, husband's a physician, wife's a business owner, excess of $500,000 of combined income. And we were reviewing their 2022 tax return. And I just noticed I saw a line item for a capital gain, and it said something in the neighborhood of like $60,000 as a capital gain. And I asked him, I said, hey, Mr. and Mrs. Klein, I said, did you sell anything, an asset for a gain in 2022? Maybe real estate, maybe investments in a brokerage account. Do you recall doing this? And they said, no, we didn't sell anything. We're too busy to sell any of our assets. I looked through the statements and it hit me. It was like, this was a capital gain distribution that was made by the fund family that they owned a mutual fund through. Okay. And so this is a big no-no. If you have a taxable brokerage account, meaning outside of your traditional 401k, outside of your Roth account, okay, those are tax advantages. If you receive a capital gain distribution inside of those accounts, it's not going to impact you from a tax standpoint. The only time you're going to have to pay taxes on a tax-deferred 401k or even sometimes a Roth account if you made a withdrawal from the portfolio. Then you might be subject to income taxes there. But in terms of a capital gain distribution, not a big deal on those types of accounts. But if it's a taxable brokerage account, if you have investments in a taxable brokerage account, you need to be very mindful of this concept of asset location. All right. So we're going to dive through. We're going to go to the whiteboard here. I'm going to walk through an example. We're going to talk through, percentage of net asset value, what's high or low in terms of a capital gain distribution, how it's taxed, and then ultimately we're going to talk about some key takeaways in which you can avoid this unpleasant surprise as you move forward in your retirement planning journey. So without further ado, why don't we jump into the whiteboard here? All right, so percentage of NAV. So NAV stands for net asset value, okay? And, this is generally how it is quoted. Sometimes it's quoted as a dollar amount relative to the number of shares, okay? But at the end of the day, you're going to get to the same end result to figure out what your distribution is going to be, okay? So let's say you own a fund, and let's say the value of that fund was $80. Let's use green. The net asset value is $80. Okay. And let's say you received a notification from the fund family. It says, hey, you know what? We're going to pay out 10% of the NAV. Okay. So 10% of NAV will be the capital gain distribution. Okay. So you might be thinking, hey, 10%, that's not too painful. Well, let's say you owned, I don't know, 1,000 shares, hypothetically. So if you own 1,000 shares of this particular investment, which will give you $80,000, would be your total value, okay? And then they say, you know what, we're going to pay 10% of the NAV. Well, you simply just take 10% of this, and that will be $8,000 will be your capital gain distribution, okay? So $8,000 is $8,000, okay? Regardless of the size of the amount, this is potentially painful to you because let's say you're planning for retirement, and let's say you're 65 years old, you're on Medicare, and you're doing some planning for your Medicare premiums. And you're looking at IRMAA surcharges for 2027. You're looking at this looking forward. And all of a sudden, you look at your tax return, and this $8,000 trips you up and you're pushed into the next IRMA surcharge bracket, and that costs you $1,500 a year, or maybe even $3,000 a year if you're married. Or maybe it pushes you into the next income tax bracket, okay? Or maybe now you're subject to net interest income taxes, okay? The Medicare surcharge tax. Little things like this can add up. And $80,000 is a relatively low amount. Let's say the portfolio value, let's say you had an asset that was $800,000 in your taxable brokerage account. Okay, now we're talking 80 grand, based on this particular percentage of NAV. And 10% is fairly high, but I've seen higher. Okay, generally speaking, we want this thing to be if you own this investment in a taxable brokerage account, truthfully, you want this to be anywhere from 0% maybe to 5% at its highest. Okay, you don't want anything higher than 5%. That is so tax inefficient. If you want to own those investments, maybe those investments make sense as part of your overall financial picture, but you want to own those types of investments inside of your retirement accounts, your IRAs, your 401ks, your Roth accounts, because that way, if they push out these taxable distributions, these capital gain distributions, that's not going to show up in your tax return. Any income or interest income or capital gains that you receive inside of those tax advantaged accounts is not going to show up in your tax return. So I guess my plea to you is review those investments. Review those investments inside of your taxable brokerage account. Are they spitting out capital gains? Not from you selling anything, but simply from you owning those particular investments on the ex-dividend date. Okay, and that's the key here is let's say you're making a purchase or a sale, and let's say you purchase the investment in December, and let's say that's a couple of days before the ex-dividend date, which is if you own this particular investment on the ex-dividend date, they will pay out that capital gain distribution for you. So you could have made this $80,000 purchase on December 10th, and let's say December 12th was the ex-dividend date. You're going to receive that capital gain distribution even though you only held that fund for a couple of days. So be mindful as to the timing. And on the flip side of that, that could also be reason for you to get out of a particular fund at a particular time in order to avoid unnecessary capital gain distributions. What are some of the ways you can avoid this thing? I mean, the number one thing I would say is make sure if you're owning funds, okay, if you own funds within a taxable brokerage account, I'm a big fan of owning ETFs or exchange traded funds, okay? An ETF is more tax efficient in the sense that there is a like-kind exchange. There's an in-kind exchange at the acquisition and at the redemption when cash is needed from the shareholders, okay? Gets a little bit complicated, but there's authorized providers that essentially hold these baskets of securities. The fund family doesn't necessarily hold the basket of securities. So if investors are flocking to the fund family, let's say in times of volatility like 2022, I just mentioned, when this client realized upwards of a $60,000 capital gain distribution, the reason that happened in a down year like 2022 was because people were flocking to the fund family saying, I want to get my cash out. I want to bail out of the market. Obviously, you and I know, if you follow PFR Nation, you don't want to invest on emotion. You want to have a long-term disciplined strategy. But if you own a mutual fund, those mutual fund portfolio managers are going to have to sell those underlying securities in order to raise the cash, and they pass on those capital gains to you as the shareholder. Okay, whereas if you own an exchange traded fund, the genetic makeup of ETFs are just more tax efficient because of this idea of this in-kind exchange, okay? Not only at acquisition, but also at purchase. Now, it's not perfect, okay? If you might own some ETFs that are a little bit more nuanced, a little bit more niche. Maybe it's an ETF of commodities, or maybe it's an ETF of real estate, or maybe it's an ETF of an emerging market basket of securities. Those might not be as liquid, and so those authorized providers might actually have to go in and actually sell those securities for the fund family instead of exchanging these baskets of securities. That could potentially trigger some taxes and those capital gain distributions to you, or potentially maybe they're actively managed. Maybe you own ETFs that are active in a sense that they're buying and selling securities all throughout the year. my plea is don't own those inside of the taxable brokerage account. You may want to own those inside of an IRA, Roth account, 401k, etc., and own more of your passively managed ETFs inside of the taxable brokerage account. Okay. The second thing I just mentioned, timing, timing your purchases properly. Just looking at the ex-dividend date, looking at, hey, if you're looking at making a purchase in December, especially a larger purchase with a larger dollar amount, just be a little bit mindful of the types of funds you're purchasing and making sure that you're not going to get hit with this unnecessary capital gain that you should have never received. Okay. A big one, in my opinion, as always, is tax loss harvest. Okay, this is why you want to harvest losses along the way. So if in periods of volatility, an asset is, let's say, down in value, go ahead and sell that asset, realize the loss. Not always, okay, but generally speaking, if you have a substantial loss, maybe it's even $5,000 or $10,000 at a loss, you still believe in this particular investment long term, but maybe you can go ahead and sell that particular investment, realize that capital loss as opposed to letting it sit as an unrealized loss, and now use those realized losses to offset some of these capital gains, whether it be in that year or even in potentially years going forward. Okay, so tax loss harvesting is a great strategy always, but certainly to offset these unrealized capital gains. Whoops. 6. Number 4, I would say choose funds, look at the turnover ratio. Okay. So the turnover ratio is how often or how frequent are these fund managers turning over the portfolio. So for portfolios with very low turnovers, okay, maybe it's less than 20%, less than even 15%, are going to be so much more tax efficient versus, let's say, funds that might have a turnover ratio of 30% or 50% or worse, 100%. Okay, and so you can check the prospectus, you can look at profiles on a bunch of different Morningstar, Yahoo Finance, wherever you're tracking funds, you can look at the turnover ratio and make sure, especially for these taxable brokerage accounts, making sure you reduce the turnover ratio, okay, with those particular investments. And honestly, a big way to do this is just avoid active investments within the taxable brokerage account. I'm not saying active investments are bad always, okay, but generally speaking, within a taxable brokerage account, you want to limit or eliminate the number of actively managed funds within your portfolio, not only even from a tax perspective, but also from a cost perspective. Does it make sense for you to pay additional fees for a portfolio that may or may not outperform their benchmark? So just be careful with these things. These are some examples in terms of, okay, hey, what are some simple ways you can eliminate or mitigate the potential impact of some of these unrealized capital gains? And again, think about asset location. I did an entire podcast on this concept of asset location. So if you're interested in that, I'll plug that into the show notes or wherever that shows up on YouTube. And be sure to check out that video or that podcast because I went into a lot more detail, not only on this particular topic, but also other topics around tax efficiency within your taxable brokerage account. So I hope it helps you all. And listen, if you're in that 50 to 60 plus range, if you're pushing or if you've exceeded 7 figures already from an investment portfolio perspective, maybe you're thinking about becoming work optional, you're not really sure if you have that possibility, make sure to subscribe to the channel, okay? And make sure to share this with someone else who's in a similar boat, okay, as you, that also might find value in this content. And of course, make sure to like this video if you found it helpful. And until next time, this is Kevin Lau signing off.